$5 billion raised. But insiders reveal the math that could crater your equity package. Anthropic's reported annual burn rate may exceed $12 billion, while revenue sits below $500 million. For tech workers holding stock options or RSUs in AI companies, that's a concentration risk that could compress your net worth by $50K, $300K within 18 months. Here's what the earnings call data actually shows, and how to spot it in your own company tonight. Most tech workers believe a $5 billion fundraise means years of runway and safety. That's the wrong belief, and it's costing people hundreds of thousands of dollars. The research shows something darker. A company burning $5 billion annually with $400 million in revenue has fewer than 3 years of runway, even with $5 billion in the bank. By year 2, when VCs demand profitability or a clear path to it, that company either restructures, dilutes aggressively in Series F, or acquires a smaller player. And when that happens, fully diluted option pools shrink by 50–90%. Your slice of the pie doesn't just get smaller in percentage terms, the pie itself shrinks in valuation. Let's ground this in numbers. OpenAI reported approximately $4 billion in annual recurring revenue as of 2024, but reportedly burns $700 million annually on infrastructure and compute. That's a 20% net margin problem, not a growth story. Now compare that to Anthropic. Raised $5 billion across multiple rounds, including Google's $2 billion investment and Amazon's reported $4 billion commitment. But according to reporting from The Information and Bloomberg, operates with estimated burn rates of $12 billion annually, with revenue likely under $500 million as of late 2024. The delta isn't small. It's the difference between a company with a 5–7 year runway and one with 2–3 years. Stop and think about what that means for your vesting schedule. Here's where your equity gets destroyed, and this is the part your grant letter won't tell you. A tech worker with a $200K salary and 0.5% of a company valued at $30 billion post-money sees a notional grant value of roughly $1.5 million fully diluted. Sounds great, but if that company faces a Series F at $15 billion, down 50% in a down market, your pool dilutes by 2x. If a Series G follows at $10 billion, you dilute again. By the time the company IPOs or acquires, your original $1.5 million grant is worth $150K, $300K in actual proceeds, an 80–90% loss in purchasing power. This isn't theory. This is precedent. WeWork secondary shareholders saw exactly this in 2019. Options granted at a $47 billion valuation, trading for cents on the dollar within 18 months. Theranos employees held equity they believed was worth $10 million notionally. After the 2015 revaluation, it was worth 0. The pattern repeats because the underlying mechanics are identical. Unsustainable burn, revenue stalls, VCs lose patience, down rounds hit, dilution accelerates, and worker equity evaporates. The Information's reporting on Anthropic's burn rate suggests that without a dramatic revenue acceleration or a new business model, like licensing infrastructure to enterprises at scale or selling API credits at substantially higher margins, the math becomes unsustainable within 24–36 months. The hidden metric you need to calculate tonight: burn rate divided by revenue. If that ratio exceeds 2:1, your company has less than 3 years of runway at current cash burn, regardless of how much they raised. Ask your finance team, what's our monthly cash burn and what's our monthly ARR? Do the math. If you're at a Series C or D where more than 30% of your net worth sits in unvested equity at that company, portfolio rebalancing conversation with a financial advisor isn't paranoid, it's prudent. It's the difference between protecting yourself and getting caught in the next WeWork. That's not guaranteed to happen at Anthropic. Claude's adoption is real, and enterprise contracts are growing. But the concentration risk is real for workers holding 20–50% of net worth in a single company's equity, especially when burn-to-revenue ratios point toward runway pressure. Your action tonight: pull your grant letter and calculate the fully diluted percentage you own. Multiply by the latest valuation you've heard. That's your notional value. Now ask yourself, if this company dilutes 50% in 2 years, can I afford it? If the answer is no, or if this equity represents more than 20% of your net worth, a conversation about systematic diversification. Selling small tranches of vested equity quarterly, rebalancing into index funds isn't pessimism, it's math.